Ethanol product logistics and blending dynamics continue to be important pieces of the transportation fuels infrastructure puzzle. To date, product has primarily been delivered to blending terminals via truck and rail. However, 2008 began to show signs of activity in the pipeline sector, which may help drive costs out of the system and allow for greater market penetration. As mentioned previously, another driver of market penetration in the medium term is the blend rate of ethanol into gasoline. The major indicators to watch are E85 station rollout and the EPA's pending discussion on intermediate blends. The latter has made significant progress in 2008-2009. The main challenges for shipping ethanol by pipeline are corrosion and affinity for water absorption, both of which have generally precluded the use of existing liquid fuel pipelines. Until recently, conventional wisdom was that dedicated pipelines were required. However, in December 2008, Kinder Morgan began shipping ethanol in the southern branch of their Plantation pipeline. The project entails a 105-mile stretch of pipeline in Florida at a reported upgrade cost of approximately $10 million. This demonstration is a leading positive indicator of the possibilities. In terms of dedicated pipelines, the vision has been to connect the Corn Belt in the Midwest to the Northeast markets via a dedicated pipeline. To this end, in March 2009, Poet and Magellan Midstream Partners kicked off a feasibility study for just such a project. Preliminary estimates suggest that a project of this sort would cost in the $3.5 billion range. Technical feasibility is one aspect to consider. How to finance a large-scale dedicated pipeline is another. There are three financing factors to take into account for this nascent segment of the industry. 1. Business model. In contrast to the business model for ethanol producers, which is subject to commodity price swings, the pipeline model is generally a toll model, whereby the operator is paid a fee for volume shipped, regardless of the price of the underlying product. This bodes well for the finance capabilities of projects, assuming the technical risks are adequately addressed. 2. Availability of project capital. This is largely a function of greater economic conditions as discussed in later sections of the report. 3. Loan guarantees. The federal government has the potential to provide loan guarantees for these projects, which would help kickstart the segment. This approach has been supported by many ethanol state members of Congress, but may require a legislative change. Beyond the introduction of pipelines for ethanol, some advanced biofuels technologies are making a push to solve the issue by producing fungible fuels that are more closely related to traditional fuels and can be pipelined with no additional upgrades. This economic benefit will be a competitive advantage for such fuels, especially in markets that are not served by major pipelines, where an economic case can be made to upgrade for ethanol. The amount of ethanol that can be blended into the general gasoline pool is limited to approximately 10% of the total volume. This remains the limit, due in part to concerns about the effects of higher ethanol blends may have on internal combustion engines, particularly as voiced by automakers and insurance companies, but in practice is controlled by the Environmental Protection Agency, EPA, on the basis of the Clean Air Act. A science and consensus-based approach is helping ensure the key constituents can participate in the rulemaking. At current levels of fuel demand, this 10% blend limit amounts to about 10 to 14 bgpy. Thus, the question arises of how the industry will be able to move beyond this level to comply with the RFS as it ratchets up every year towards the 36 bgpy target in 2022.